The invisible tripwires of the 2026 tax machine. Most people live in a state of low-level anxiety regarding the IRS, but they view a tax audit like a lightning strike, a random, unfortunate act of God. However, if we perform a forensic audit on the internal selection criteria of the modern tax system, we find that audits are not random at all. In the 2026 economy, the IRS has shifted from manual reviews to AI-driven predictive non-compliance models. They are no longer looking for mistakes, they are looking for outliers. There is a specific tax mirage that many building wealth fall into. They believe that as long as they aren't rich, they are invisible. But the data reveals a chilling reality. The IRS is systematically targeting 3 specific levels of net worth and income where the potential for harvesting unpaid revenue is highest. Today, we are going to look at the 3 net worth levels that trigger an audit and why reaching these milestones changes your relationship with the government forever.
Level number 1, the high engagement professional, $200,000 to $500,000 income. The first major tripwire isn't a net worth figure but an income threshold that signals you have entered the audit sweet spot. Once your household income crosses the $200,000 mark, your statistical probability of an audit increases by over 300% compared to someone earning $75,000. Why? Because at this level, you are earning enough to have complex deductions, but usually aren't wealthy enough to have a permanent team of tax attorneys shielding every dollar. At this stage, many people fall for the deduction trap. They start a side business, what we call a lifestyle business, and attempt to write off their personal life as corporate expenses. The algorithm is looking for the business/hobby blur. If you earn $300,000 as a doctor, but claim your $40,000 photography business lost money for 3 years straight, you aren't being clever. You are lighting a signal flare for the IRS.
In the 2026 landscape, the IRS is specifically looking for unfunded lifestyles. They compare your reported income against your consumption signature, the data they gather from your zip code, your car registrations, and your public social media footprint. If you report $180,000 in income but live in a zip code where the median home is $2 million, and you drive a vehicle with a $1,200 monthly payment, the AI flags a solvency mismatch. They don't need to see your bank account to know you are hiding something. They just need to see your front door. Reaching this level of income is a milestone of success, but it also marks the end of your tax anonymity. You have moved from a retail taxpayer to a high engagement account, and the system is now algorithmically programmed to ensure you are paying the maximum possible admission fee to the middle class. The millionaire trap and the retirement tax bomb. As your net worth climbs from the mid-6 figures into the $1 million to $5 million range, the IRS shifts its focus. They are no longer just looking at your paycheck. They are looking at your storage unit. At this level, most of your wealth is likely locked in tax-deferred vehicles like a traditional 401k or trapped in real estate equity. To you, a $2 million 401k balance is a badge of honor. To the IRS, it is unharvested revenue. Level number 2, the mass affluent trap. $1 million to $5 million net worth. The danger of this level is what I call the slow-motion tax trap. For decades, you've been told to maximize your 401k to lower your taxes today. But the IRS is playing a longer game. They're waiting for you to reach age 73 or 75, at which point they hand you the bill through required minimum distributions, RMDs. At age 73, the government effectively takes the key to your storage unit and forces you to start clearing it out, whether you need the money or not. If you have $2 million in a traditional 401k, your first RMD will be roughly $75,000, taxed entirely as ordinary income, not at the lower long-term capital gains rates. When you add Social Security, which can be up to 85% taxable at this income level, you suddenly find yourself in a higher tax bracket in retirement than you were during your working years. You didn't defer your taxes. You just gave yourself a mandatory tax increase on layaway. But it gets more aggressive. In 2026, the IRS is using cascading tax consequences to extract more value.
A large RMD doesn't just increase your income tax. It triggers the IRMAA, Income-Related Monthly Adjustment Amount, CLIF. If your RMD pushes your income above specific thresholds, roughly $109,000 for singles in 2026, your Medicare Part B and Part D premiums can skyrocket, adding thousands of dollars in hidden taxes to your retirement costs. The IRS is so focused on this millionaire trap that new laws like Secure 2.0 have already begun mandating that high earners, those making over $150,000, put their catch-up contributions into Roth accounts rather than traditional ones. The government has done the math. They realize that if everyone stays in the tax-deferred cage, the future revenue implications are messy. They are legally redirecting you because they want their cut now. If you are at this level, the algorithm flags you for asset-based outliers. They track your property tax records and luxury asset registrations. If you are reporting modest retirement income but own a $3 million secondary residence with no mortgage, the AI flags a solvency mismatch. They suspect you are buy, borrow, die, the strategy used by the ultra-wealthy to live off loans against assets to avoid triggering taxable events. While this is legal for billionaires, the IRS is increasingly scrutinizing the mass affluent who try to mimic these structures without the proper legal shielding. In the final part, we will look at level number 3, the legacy exit, where the IRS watches your reputation as much as your accounts. We will also reveal the sovereignty protocol, how to build the bridge account to make yourself un-harvestable and ensure you own the keys to your own storage unit. The legacy trap and the sovereignty protocol. As you move beyond the mass affluent stage and enter the third tier, the IRS changes its objective. They are no longer looking to tax your income or even your retirement distributions. They are looking to tax your existence. In the barbell economy of 2026, wealth is highly concentrated. And the government has realized that the most efficient way to capture revenue is to wait for the great wealth transfer. Level number 3, the legacy exit, tripwire, $10 million plus net worth. When your net worth crosses the $10 million threshold, you trigger the estate and gift tax forensic audit. While many believe the estate tax only applies to billionaires, the reality of 2026 is different. With the sunset of the Tax Cuts and Jobs Act (TCJA) provisions, the exemption levels have reverted to much lower historical norms. If you own a primary residence in a major city, a secondary property, and a robust 401k portfolio, you are statistically likely to leave your heirs with a massive success tax invoice. The IRS algorithm at this level is specifically programmed to find shadow wealth transfers. They look at intra-family loans with 0% interest, the sudden gifting of equity in family businesses, and the undervaluation of assets moved into dynasty trusts. They aren't just checking your math, they are checking your intent. The AI compares your children's consumption signatures against their reported incomes. If your 24-year-old child reports $45,000 in income but owns a condo with no mortgage, the system flags a generational solvency mismatch. They know the money came from somewhere, and they want their cut of the informal distribution. At this stage, your reputation becomes a financial instrument that the IRS watches closely. They monitor your reach as much as your worth. If you are an officer in a foundation or a private equity operating partner, you have moved from being a taxpayer to being a regulatory outlier. The machine is designed to ensure that as you exit the system, you pay the ultimate exit fee. The Sovereignty Protocol, building the bridge. To escape the AI-driven tripwires and the slow-motion tax trap, you must implement the Sovereignty Protocol. This protocol is built on the principle that the safest taxpayer is a diversified taxpayer. Step 1. Build the bridge account. The traditional 401k is a tax-advantaged cage. It locks your capital until 59.5 and then taxes it as ordinary income at the highest possible rates on the way out. The Sovereignty Protocol dictates that you prioritize a taxable brokerage account. This is your bridge account. In a brokerage account, you are taxed at preferential long-term capital gains rates, usually 15% or 20% in 2026. rather than the 32% or 35% ordinary income rates of a 401k. Furthermore, you gain access to tax loss harvesting, which allows you to offset your gains and even up to $3,000 of ordinary income annually. By building this bridge, you give yourself the outside option value to retire at 45 or 50 without asking the IRS for permission. Step 2. The Roth conversion window. If you have a large traditional 401k, you are sitting on a tax bomb. The strategy for 2026 is to utilize the hidden Roth conversion window. Between the ages of 60 and 67, or during any low-income gap year, you should aggressively convert traditional assets to Roth accounts. You pay the tax today at a known rate, perhaps 22% or 24%, to avoid being forced to withdraw that money later at an unknown, likely higher rate via required minimum distributions, RMDs. Roth accounts have no RMDs and no tax on distributions, effectively disarming the IRS's future claims on your wealth. Step 3. Triple Tax Advantage, the HSA. The HSA is the only account in the U.S. tax code with a triple tax advantage. Contributions are pre-tax, growth is tax-free, and withdrawals for medical expenses are tax-free. Given that the average couple will spend over $300,000 on healthcare in retirement, the HSA is your ultimate insurance policy against the IRMAA cliff. By paying medical bills out of pocket now and letting the HSA compound, you build a tax-free fortress that the IRS can't touch. The final audit. The IRS is not a force of nature. It is a system of incentives. The success script of the past told you to defer everything. But in the 2026 economy, deferral is a high-risk gamble on future government solvency. True wealth is not the number on your statement. It is the net of tax optionality you control. Stop being a high-engagement account that the system harvests for revenue. Start being a sovereign capital allocator. Move your money from the storage unit that the government holds the key to and into the sovereign vault that you control. True freedom is the silence of a life where the taxman has nothing to look for. It is the ability to wake up on a Tuesday morning and realize that your capital architecture is un-harvestable. Build your bridge, secure your vault, and opt out of the trap. If this forensic audit of the 3 net worth levels changed how you see your tax return, hit that subscribe button. We are dissecting the hidden mechanics of wealth every week to help you stop being the product and start being the owner. I'm Dave, and I will see you in the next one.